Part 1. How wars impact financial markets. Understanding risk-off behavior. Wars dominate headlines and trigger strong emotional reactions. For investors, geopolitical conflict often feels like pure chaos. Markets swing violently, commentators speak in extremes, and fear spreads faster than facts. But beneath the noise, financial markets do not behave randomly. They follow patterns that have repeated across decades of geopolitical shocks. The first and most important concept to understand is risk-off behavior. War introduces uncertainty, not just about outcomes, but about timelines, economic costs, and political responses. Uncertainty is the single most disruptive force in financial markets. When uncertainty rises, investors do not ask whether an asset is cheap or expensive. They ask whether it is safe. This shift marks the transition from risk-on to risk-off. In a risk-off environment, capital becomes defensive. Investors reduce exposure to assets perceived as volatile and increase exposure to assets perceived as stable. This is not driven by emotion alone. It is driven by risk management, institutional mandates, and capital preservation strategies. Importantly, markets do not react to wars because of moral judgments or political alignment. They react because wars increase volatility, reduce visibility, and complicate forecasting. Markets price uncertainty, not ideology. During the initial phase of a war-driven shock, several things tend to happen simultaneously. Volatility spikes. Liquidity in certain assets temporarily dries up. Correlations across markets increase, meaning assets that normally move independently begin to move together. This is why investors often feel that everything is falling at once. However, this phase is usually short-lived. The goal of risk-off positioning is not to exit markets permanently. It is to survive uncertainty until clearer signals emerge. Once the uncertainty stabilizes, capital begins to reposition again. Another important misconception is the idea that wars automatically destroy markets. History does not support this. While wars create short-term dislocations, financial markets are adaptive systems. They adjust to new realities faster than public narratives suggest. Markets are forward-looking. They do not wait for wars to end before recalibrating. They respond to changes in expectations, policy responses, and liquidity conditions long before certainty returns. This is why the most violent market moves often occur at the beginning of geopolitical shocks, not at their resolution. Understanding this behavior is crucial. Investors who interpret every geopolitical event as a permanent breakdown tend to overreact. They sell into fear, reduce exposure at the worst possible time, and miss the structural forces that ultimately drive recovery. Risk-off does not mean collapse, it means repositioning. In the next part, we will explore where money actually flows during wars and why capital does not disappear during geopolitical crises. It simply moves. Part 2. Capital flows during wars, safe havens, volatility, and market adaptation. When war enters the picture, one of the most common fears is that capital will leave the market. In reality, capital rarely disappears. It moves, reallocates, and seeks liquidity. Understanding these capital flows is far more valuable than reacting to price movements alone. Historically, wars trigger a predictable reshuffling of capital. One of the first destinations is government bonds, particularly those issued by economically dominant countries. This is not because bonds suddenly offer high returns, but because they provide perceived stability. In periods of uncertainty, safety becomes more valuable than yield. Another recurring pattern is demand for the US dollar. During global stress, the dollar often strengthens, not due to optimism about growth, but because it represents the deepest and most liquid financial system in the world. When global investors need flexibility, they move toward liquidity. Gold also plays a role, though its behavior is often misunderstood. Gold functions as a psychological hedge. Its performance varies depending on inflation expectations, interest rates, and monetary policy, but its symbolic role during conflict remains consistent. It represents continuity in times of disruption. Equity markets tend to react with heightened volatility, rather than permanent decline. Stock prices reflect expectations about future earnings, not present fear. As uncertainty peaks, valuations adjust quickly, but once markets begin to price in policy responses and economic adaptation, equities often stabilize faster than headlines suggest. A key reason markets recover is that economies do not stop functioning during wars. Production shifts, supply chains adapt, and capital continues to seek opportunity. Markets reflect these adjustments long before they become obvious to the public. Another critical factor is time horizon. Short-term traders respond to headlines. Long-term capital responds to structural changes. During wars, these two forces collide, creating sharp but temporary dislocations. It is also important to understand that markets differentiate between localized conflicts and systemic risk. Not all wars carry the same global financial implications. Markets assess scale, duration, and economic exposure, rather than reacting uniformly. This distinction explains why some geopolitical events trigger major market reactions, while others barely register beyond short-term volatility. The mistake many investors make is assuming that volatility equals long-term damage. In reality, volatility is often the price of adaptation. Markets must reprice risk before they can resume normal functioning. In the next part, we will examine the role of central banks in liquidity during wars, and why monetary responses often matter more than the conflict itself. Part 3. War, Liquidity, and Market Cycles. Why markets often recover faster than expected. Wars place enormous pressure on governments and financial systems. They increase fiscal spending, strain budgets, and force difficult policy decisions. But from a market perspective, one factor consistently outweighs all others: liquidity. Historically, wars lead to expanded government spending. Defense budgets rise, public spending increases, and fiscal deficits widen. To finance these costs, governments issue debt. This process inevitably draws central banks into the picture. Central banks are tasked with maintaining financial stability. During periods of extreme uncertainty, their priority shifts from controlling inflation to preventing systemic breakdown. This often leads to accommodative policies, either directly or indirectly. Liquidity matters because markets are not driven solely by economic growth. They are driven by the availability of capital. When liquidity increases, risk assets eventually respond, regardless of geopolitical tension. This is why many major market recoveries occur after periods of geopolitical stress. Once uncertainty stabilizes and liquidity conditions improve, capital begins to flow back into risk assets. This pattern applies across asset classes, including equities and digital assets. Crypto markets in particular tend to amplify liquidity cycles. In the initial phase of war-driven risk-off, crypto often declines sharply, but over time, its performance becomes increasingly tied to global liquidity and monetary conditions. This behavior reinforces a critical lesson: reacting to fear is rarely a winning strategy. Retail investors often make the same mistakes during geopolitical shocks. They sell when volatility peaks, wait for clarity that never arrives, and re-enter markets after prices have already adjusted. Markets move ahead of narratives. By the time fear subsides, opportunity is often gone. Understanding market cycles provides a framework for navigating uncertainty. Wars are disruptive, but they are not anomalies. Markets have absorbed geopolitical shocks throughout history and continue to function. The key is not to predict outcomes, but to understand behavior. Markets remember liquidity, capital flows, and cycles, and not headlines. By focusing on structure rather than emotion, investors gain clarity during periods when most are overwhelmed by noise. That is the true edge. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from Macrocycle Lab. See you in the next video.